Hi everyone, it's time for us to take a look at the second quarter investment outlook. We see three key trends need special attention in quarter two. The first trend, the best trading strategy in the last 12 months. US versus China equities arbitrage in the tech sectors. It generated over 80% absolute gains in the last 12 months. Second, successful AI utilization brings up equities valuations. Third, US drastic policies to debt reduction forcing investors' reassessment of global investment risks. We are happy to review what we have said in quarter one. We see upside potential in equities and alternatives, especially in the technology sector in Hong Kong and China stock markets. We also see support for gold and bitcoins of the alternatives assets. And AI theme is something that we find very interesting and it would make an impact to the stock market. Flattish US interest rate outlook, and we are correct to say no collapse in the US stock market, yet consolidation may happen. We are benefiting from our constructive tactics for the Q1, and our exposure to technology sector in Hong Kong, China is up 17% year to date, and the exposure to gold up 14%. These numbers are all passive index ETF fund year-to-date returns. Now let us take a look at the financial markets performance year-to-date. We see good performance year-to-date from the commodities gold, and we see good equity returns from the DAX index, the Germany stock market, Hong Kong, and the Hong Kong Technology Index. The best performing is the Technology Index in Hong Kong. It's up 24% year to date. And for 1 year, it has been up 61%. After seeing all these numbers, we expect a deeper correction in US equity in coming quarter, and we will see continued relative outperformance of Hong Kong and China stock market in Q2 2025. We remain positive on the gold and selective alternative asset in Q2 of 2025. Overall speaking, barbell investment strategy so far works very well by buying both high risk and low risk assets to tailor fit one's risk appetite. We will continue to adopt this barbell strategy. We see currencies volatilities against US dollar, especially with those major trading currencies. So far, year to date is within 5% fluctuation range. We expect it will maintain that sort of range in the coming quarter as our base case scenario. Global investors are diversifying the currencies mix, with funding coming mainly from reducing US denominated assets. US interest rate will also stay sluggish and try not to move drastically up or down especially when the current US administration is imposing trade tariffs on foreign trade partners. So far, year to date, we see quite a decent positive return in our Q1 asset allocation returns. We do let our fundamental view won over political concerns and blend it into our investment actions. We make these decisions based on our own deep fundamental research and according to hot data available. Then, judging from the global funds flow directions, we arrive at our Q2 tactics and strategy, and subsequently, our midterm overweighting investment targets. We emphasize on the economic fundamentals. We see technology edges and company strengths. We also pay attention greatly to effective government policies. These factors are forming the main arguments for our investment actions. Now, let us see what is important for an investor when they judge which country will be more preferred as an immediate investment target within other countries. Now you see the table of country A and B and the GDP, the government bond yield, and the currency fluctuations year to date, the stock index performance in the last 12 months year to date, and the purchasing power of the currencies using 10 pieces of bread as a proxy, and also showing the unemployment rate. Please note that the local currency terms for the economic data are used, except for the price of bread, in order to have a proxy that can be comparable. Now, we also see the numbers for the stock index in country A and country B. And we are comparing the technology sectors with technology sectors, apple to apple, in two different countries. And we see a higher GDP growth in country A, a lower CPI, and a lower government bond yield, and a bit higher unemployment, yet the purchasing power of the currency is more than double than country B. Country B have a higher bond yield, interest rate, it means, higher CPI, and almost half the growth of GDP of country A. Comparing the performance, country A have a much higher stock performance, positively 17% year to date, tech index up 24%, comparing with a minus 6% in the correspondent index year to date. Now the question to you is which country you will buy or overweight in coming quarter? The hint for you is that once a trend is formed, according to our research, it will continue for 3 months if it already have a trend formed for 3 months. There are very high chances, according to our prediction, 80% of the chances that will continue the outperforming or underperforming trend for the next 6 months. If the fundamental picture doesn't change. Country A is more attractive in our opinions. We see fundamentally country A is more sound when it compared with country B. We take the real numbers, and country A is China and country B is US. With the Hong Kong US dollar peg, there are very little chance in our opinion that in the coming 3 quarters this peg will break. And it caused a lot of convenience for the US dollar denominated investor coming to buy Hong Kong or China assets. We conclude that global investors have made their decisions based on fundamentals, better equity valuations, competitive AI know-how and adoption, solid manufacturing capabilities, and almost zero FX translation risk through the peg. And the investor have voted yes with the money inflow. The turnover of Hong Kong Stock Exchange has increased 26 times in the last 12 months. It is saying that not only inflow from China is buying into the market, and also foreign money are coming into the market. Judging from all the facts that we have gathered so far, we have our information that rough tactics to defuse US debt bomb, assuming debt reduction is the prime aim of current US administration. There is likely one possible path, taking the silver bullet for transforming US economic doldrum. Reduce the value of government debt through sharp decline in bond price. Without default, the usual trigger was higher interest rate. Reduce government expenditure, what Elon Musk is doing now. Increase government revenue through charging all kinds of tariffs from friends and foes, forcing foreign countries to directly invest in US, repay by retiring the government's debt through gold and Bitcoin strategic reserves. If this was the path chosen, US interest rate will go up, FX rate will go lower, gold and Bitcoin price will stay high, tariffs will continue, CPI will be higher. Abundant volatilities in US financial markets and other, at least some major markets, will benefit. As a result, personal asset allocation for Q2 2025, we would like to reduce the risk assets by 7% while maintaining the alternative assets exposure. We have put the money into the cash for bottom fishing, and we have parked the money into very high grade bond and fixed deposits. It's a risk reduction overall speaking for Q2. We have to keep alert to changes and be ready running for life at any time. Wish you all the best in Q2 2025. Good luck and thank you all of you.